Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite.com and FundingStack.com. Today I have Victor Cardenas of Slash coming to us from San Francisco. How's your day going?
It's going great, Nathan. Thank you so much for the invitation.
Yeah, excited to hear the story. It sounds like an interesting one. So let's start off with, what is Slash? What do you guys do?
Nathan, Slash is the fastest growing business banking and corporate credit card platform in the US. We work with over 7,000 businesses. They collectively spend over $10 billion a year on our cards. And, we were built around this central thesis that your bank account can and should do much more for you than just let you hold and send your money. It should be the place where you reimburse your employees for out-of-pocket expenses, where you issue invoices to get paid from your customers, where you can spot and cut wasteful spend and do a lot more. We have ambitions to be the largest corporate credit card issuer, the largest business banking platform in the US, taking it day by day and having a lot of fun building this business.
So credit cards, banking, invoicing, like what are the sort of the top 3 or 5, services that your folks, customers are using? Yeah.
Bank accounts, treasury accounts that allows customers to invest in money market funds that have a high yield, corporate credit card, invoicing, bill pay, expense management, and accounting automation. So we actually make it possible for finance teams to spend a lot less time manually coding transactions before sending them to their ERP, because we can pre-categorize them based on some certain heuristics that live in Slash. So if you think of a business that issues, if you think of a business pre-Slash, you'd have an American Express, one American Express, and you'd make a bunch of vendor transactions on them. And then your accountants would have to manually tag every single one of your transactions in QuickBooks and say, hey, this account is meals, this account is software expenses, this transaction represents something else. Versus with Slash, what you can do is you can create distinct virtual cards for every single use case and make it such that every single time you use a particular card, that transaction gets coded in a particular way. So your accountants actually have to spend way less time manually coding transactions. And that's a small subset of the features that we actually offer. We have a stablecoin payments product. So we are one of the only business banking platforms in the US that lets business owners send and receive stablecoin natively from their business banking platform, the same way they could send or receive a wire in ACH. And those are just some of the products that we offer our customers.
What's a lot there, and we'll come back to this in a minute, but what's the kind of core use case for stablecoin payments? Like, what are you seeing people doing with that?
Yeah, a lot of import-export businesses. So a lot of American businesses that do one of two things: sell product to businesses internationally, and then get paid when they sell that product via stablecoin, because these businesses in Latin America or Asia typically prefer to make supplier payments in stablecoin versus Swift, which is more expensive and slower. And then vice versa, which is maybe an American business that's procuring inventory abroad, and these counterparties that they're doing business with are increasingly asking to get paid via stablecoin, just because it's much better to do trade or business using a payment rail that settles instantly. You send a stablecoin payment, it's received right away, and it's very low cost to accept. If you send a Swift payment, it takes 5 days. You have to typically pay some FX fee for the recipients to receive it in local currency, and then get charged a bunch of fees by intermediary banks along the way. So that's really the main use case. And there's an increasing amount of American businesses that are taking payments from businesses abroad, and it's really those global businesses that are driving the adoption of stablecoins in the US.
Okay, interesting. We'll come back to kind of what you guys do and where you're going, but let's go back in time a little bit. You didn't start doing this. Maybe talk about the genesis and the history. I think there's an interesting story here.
Yeah. The story I talk less about. Everyone knows that Slash, or I've talked a lot about the fact that Slash was born out of the sneaker resale space. The majority of our customers, when we first got started building in this better business banking product category at the beginning, sneaker resellers were our main customer. But before we were even doing that, my co-founder and I were actually working on a subscription splitting app. Right around the time that the pandemic started, I noticed that it used to be the case that you could access all the digital content you wanted by purchasing one Netflix subscription, $14 a month. But now there are all these different services: HBO Max, Paramount Plus, Peacock, Disney Plus. And there's a statistic out there that said that 60% of all millennials shared access to one of these streaming services. And so we said, oh, it's probably quite annoying for people to have to Venmo each other every single month or Zelle each other every single month and when they have one of these shared accounts. Let's create a product that lets our customers create a distinct virtual card for each one of the services that they purchase. And let's make those cards shareable. Let's make it possible for Nathan, you and I, to have a card. Whenever Netflix charges it $20, it takes $10 from your account, $10 from mine. And we spent actually a very long time working on different flavors of this idea, and it went nowhere. Basically, the pivot into doing credit cards or bank accounts for sneaker resellers came because we already had the infrastructure built out to actually issue cards and open bank accounts. So that was kind of where the business got started. And right before we started YC, we met the founder of this company called Hyper. They're not around anymore, but they were a platform at the time that let you sell access to your Discord server. So if you're a person that has information to sell, you typically would use this platform. And a lot of the people that had information to sell were these sneaker resellers. The majority of the communities on Hyper were these communities of sneaker resellers. And he said, hey, look, it sounds like these sneaker reseller guys have very bespoke banking needs. Victor, you should go talk to them and figure out what they're doing. And I did, and we decided to pivot the business around quite quickly. Found explosive product market fit in that market, and then it has been nothing but a straight line. It has been very far from a straight line to go from that point to where we are now. But the ups have thankfully been higher or larger than the downs.
Well, so what happened? I mean, so let's keep going with that story because I think that's interesting, right? You're doing banking or credit cards for sneaker resellers, and then, did it just sort of expand beyond that market, or was it an actual like kind of pivot, or what do you want to call this?
So I don't know. I don't think it was a pivot. I since May of 2021, which is when we onboarded our first sneaker reseller customer, we have just been making improvements to the same core product, which is a banking platform for business owners. And we had a self-employed focus to begin with, these teenage sneaker resellers. And we've slowly gone up market. And now our focus is actually the mid-market. So businesses that do over $20 million in revenue per year. And so the story of how we grew out of that market was, one, it actually fell out from under us. Right after we raised our Series A, 11 months after we were our first customer, we were doing $5 million in annual revenue. I was 20 years old. I just dropped out of Stanford. We raised this fancy $15 million Series A. Everything was up and to the right. And right after that happened, Kanye West started going on this anti-Semitic podcast tour.
Yeah.
And at the time, 90% of our customers were still in the sneaker resale space. And 70% of all the spend on Slash was at Yeezy, Kanye West brand. And so when Adidas and Yeezy cut ties, our revenue basically tanked by 70%. And it was a very, very tough moment for me as an entrepreneur. I considered at some point giving some of the money that we'd raised back. I hired a lot of people that were much older than me and sold them on this vision of the business I wasn't sure I could fulfill anymore. But in hindsight, it was the best thing that happened to us because it forced us in earnest to build towards other markets. We were never going to build a big business selling credit cards to sneaker resellers. That was just never going to happen. And so the process of actually expanding out of it was a process of going back to all these sneaker resellers who were no longer reselling and were starting new businesses. Amazon reselling was the most common. Affiliate marketing was very common. People that started marketing agencies, that was also very common. And being like, hey, how can we go and deliver differentiated value for you now that you're running a more of a big boy business, or you're operating in a segment where perhaps our product is not the most relevant for? And it was just really an exercise of something super close to our customers. And I think that's just been one of the biggest learnings. YC hammers it to you, but it never really goes away, which is you always have to be talking to the customer. You win when your customer writes your product roadmap for you. And we won and got out of that hole and expanded out of that market by just staying super close to these entrepreneurs we had a great relationship with that we're now doing something else.
That's super interesting. So yeah, your customers' businesses collapsed. They evolved. into other businesses, and you just kind of follow them into these other businesses in a nutshell, right? I mean, is that
In a
what I mean?
nutshell, in a
Yeah,
nutshell, exactly.
that's interesting. I'm actually amazed that you were able to raise a $50 million Series A for credit cards for
One
sneakers
five, one
resellers.
five, 15.
1.5. Still, that's
Yeah,
15
well,
million is
yeah.
still a
So there
lot
you
for.
go. I think okay. Now on the topic of the podcast, how I raised it. I think I figured out quite early, um, almost by necessity, that there are two ways entrepreneurs describe their businesses. One is they describe what they are physically doing
Yeah,
or what they are physically doing like next to grow their company, which is actually what as an entrepreneur you should be spending most of your time thinking about. How do I get more revenue? Like how do I get more customers? How can I distribute my product more effectively? Um, that's how what you should be thinking about how to operate the business on a day to day. But then there's another way entrepreneurs describe their business, which is this long term aspirational thing that they very much want to accomplish. And their current traction or version of the business informs the investor of their ability to fulfill on that vision. So for us, we didn't go out and pitch investors on what's the immediate next thing we're going to do, which is, hey, let's just here are all the creative ways we're going to convince more sneaker resellers to hop on Slash, right? Which is what I was actually thinking about all the time and what you should be doing as an entrepreneur. It's thinking about how to actually grow your business. It was, we want to build, we want to become the JP Morgan Chase of the 21st century. We want to be the largest commercial credit card issuer in the country. And we're going to get there by building differentiated banking products on an industry by industry basis. We grew explosively in this one small market, and our basically our business defied the laws of fintech physics, which is that LTV to CAC sucks. Usually, most fintech companies have such undifferentiated products that they have to offer these massive sign-on bonuses or spend a fortune on paid ads to generate interest for their product. And we had the opposite problem, which was we went $0 to $5 million in ultra high quality, ultra high gross margin ARR in 1 year. Because our product was just so tailor-made for this one industry. And so we said, you know what? It's probably the case that the financial workflows of businesses in every industry vary so much from each other that we can replicate the same playbook, the same explosive flywheel-driven growth in much larger, much more attractive industries. And that actually is in earnest what we have done. But that was a promise that we made to investors at the time. It was like, we're just going to build a big SMB or business banking platform, not, hey, like we're going to be the best credit card for sneaker resellers, because that wouldn't have gotten us a single dollar. So it's interesting having to toggle between those two modes of long-term ambitious, where's 30,000 foot view, where's the business going, and short-term practical, how am I actually going to grow the business tomorrow? And I think usually it's best if those two things are the same. For us, for us right now, they 100% are. Like when I describe like how we're going to do next, what we're going to do next, it's just an earnest description of how we're going to continue growing the business in perpetuity. But at the time, I had to get a little bit creative and think a little bit about how was I going to be growing my business in the medium term future instead of the immediate term.
I like that. I mean, I think that's great advice, especially for folks starting in more of a niche business, is like being able to toggle between what we're doing in this business and then this bigger vision. Super interesting. What if you can just give one example, like, because I think of banking and credit cards as pretty much commoditized businesses, right? So what was sort of unique or special about how you were giving this stuff to sneaker resellers? What was different about it that served their needs?
Yeah.
Yeah.
Well, there's a few different things. Well, sneaker resellers were not very credit worthy people. They're like teenagers, right? And so they basically, and we weren't comfortable underwriting them either, right? Because we with their teenagers, like I don't know, you have no FICO score basically. And so, but then they had a big problem, which is I'm a sneaker reseller. I want to buy 20,000. I have $20,000 sitting in my Wells Fargo account, right? And I want to buy $10,000 worth of sneakers in this one particular drop in one day. Most debit cards actually cap the amount of money that you can spend in a given day in a pretty draconian way. You can spend like $1,000 a day. And then if you want to limit the tire for that particular day, you like have to physically call the bank and ask them to raise the limit. And so one of the things was just like, hey, sneaker resellers, you can come to us and you can spend as much money as you want on a debit card on any particular day, so long as you have the money actually sitting in your account. That was one. And then the other one is the places where these sneaker resellers bought inventory actually like raffled it off. And so if you have one debit card, you can enter the raffle once. If you have multiple debit cards, you can enter the raffle multiple times on behalf of like all your different friends, which is what they were doing before. They were using like their debit card, their moms, their cousins, etc. And so this product just allowed them to do that in a pretty systematic way. So that was how we had differentiated then. Like obviously the way we've differentiated now and much other in other industries is completely different, but that was the insight at the time.
Is it hard? Okay, so you guys started this when you were in college at Stanford,
I
right?
started this business. I started so in July of 2020. So I was 18 years old when I started I started this company.
So I can understand how, given your age and the fact that your customers were basically the same age, you could understand their needs really well. Is it hard to replicate that if you're going into fashion or any other industry, basically
Honestly,
industrial components, right? Is it hard to get your hands around those industries and how you would tailor it, or what? What's your playbook?
not really actually. Like, oh, maybe I'll answer by giving the playbook and then I'll loop back to
Yeah,
the
yeah,
first
yeah.
one, which is like there's something to be said about just becoming intimately familiar with a given industry, and you can actually do that very quickly. What we've seen is that Slash has a very vertical by vertical approach to go to market and product. And it
Can I
usually takes
interrupt? What was the next one after sneakers? Like, what was your sort of next industry, or a couple examples? Yeah.
marketing agencies was the next one after
Okay.
that. So the in marketing agencies, what we figured out was these businesses are spending money on behalf of dozens or hundreds of different brands, and they have no way of keeping all of these prepayments that they're getting organized. Right? I'm a brand. I have 100 different customers at the beginning of every month. Customer one sends me 50K, customer two sends me 70K, customer three sends me 130, et cetera, et cetera. Suddenly I have $7 million sitting in my Chase account. So nothing in my Chase account tells me what of that belongs to each one of my end customers. And so it's a mess. I need to have an on-payroll person that keeps track of all that manually. We built a product that actually allows them to create a distinct sub-account for each one of their end customers and give the end customer visibility into how much of the prepayment is left. So that was one of them. But no, it usually takes us 3 months to penetrate a new vertical. That's kind of what we found, which is it starts by just getting to know a lot of people in the space, finance professionals and entrepreneurs, integrating with some bespoke tool or system of record or software that's very common in that industry, and then finding the right referral partners. And that really is the playbook. Don't want to give too much of the secret sauce,
Sure.
but I'll give you an example of a new vertical that we just penetrated, which are venture-backed startups. And it's timely actually that we're doing this this call. For the longest time, I resisted the urge to break into startups because it was so competitive. It was like Brex exists, Ramp exists, Mercury exists. There's this new company called Row, and they're offering people Rolexes to sign up for their banking product. And like, but then I realized, like, look, tech is only going to become a more important part of the American economy. Our product is actually better than theirs. There's probably a way we can differentiate for them. Let's just do it. And in December of last year, Nathan, our customers had $250 million. Like the AUM on Slash was $250 million. Today it's $1.1 billion. Because we traditionally only sold to these high TPV, high card spend customers, and it just took us a half a year, like a few months, like 4 or 5 months to really figure out the startups motion. And now we have like 20% of the spring 26 batch on Slash of YC. And it really is just a matter. And the differentiation for startups, for example, is it's actually hard for it to exist at the product layer. So what we even tell our customers is, look, banking is a commodity. Like, our product is probably actually like quite similar to our competitors' products. Sure, there might be some like small differences in rates here and there, but our job for startup founders is to maximize the probability that they are successful. I've over the last 6 years gotten to know hundreds of venture capitalists. I've hired ex VCs, ex-founders that are connected to so many of them. And so we actually are extremely incentive aligned. If we're our customer's banking platform, it's much easier for us to take one customer from having $1 million in their accounts to them having 10 million than for us to acquire 10 customers that have 1 million. So we actually help them raise money. We introduce them to investors. We give them feedback on their pitch. And we provide that as just kind of like a value added service our team does. And that's actually been quite differentiating. And there's lots of amazing rounds that we've helped put together already for our customers.
That's such a wild concept. And I've seen that. I guess maybe it was Mercury does it too, but whatever. I've seen this, but such a wild concept that your bank, your credit card provider might also help you raise capital. It's like 10 years ago or 15 years ago. That's like
Well, actually,
an
I think
absurd idea, but
maybe, but I actually think it was it actually became an absurd idea and was actually normal. Like if you think of well, a couple of things. One is SVB. Like
yeah,
when we first got started, I never thought Slash would end up being what it is now, and we sell to a lot of the businesses in the venture space. But like they introduced me to lots of investors, and they give me a venture
true.
term sheet. So in a sense, it is the job of your banking platform to like help capitalize your business. Like JP Morgan has an investment bank, right? It actually like it physically actually helps you raise these like IPO, take your company public. So in a way, this is a somewhat of an analog to that.
You're right. And I forgot about SVB's kind of, some of their matchmaking stuff they were doing. Yeah, you're absolutely right. There is a predecessor concept. Very interesting. Let's see here. So, how much have you guys raised? I know the last round was a big one.
160 million dollars in total equity, all equity.
And was first amount just the YC?
First amount was the YC 125K.
Yeah.
Actually, before we did YC, we did this accelerator called Pioneer. They actually got 1% of our business for $10 and a bunch of AWS credits. So it was this like online accelerator program. I actually think it got us quite organized, so I don't regret doing it. But fun fact, I literally signed a deal where I sold 1% of my entire company for $10. And then that they own a big chunk of Slash today. It's worth many millions of dollars.
That's amazing. Gosh, that's great. I mean, for them. And then you went. So you did that. Then you went into YC.
125K.
Yeah.
And then while we were in the batch, we had some like working capital needs. And we raised some money at incremental caps. Justin Mateen, one of the co-founders of Tinder, he was first money in after YC. And then we had a couple other angels come in at like 8 million, 15 million valuation. And then NEA led the official seed round, which was they put $2.5 million at a $25 million valuation. And so after NEA put their money in, we had raised 4 million in total from YC and all these early stage investors. And then we raised a $15 million Series A in April of 22. We raised a $41 million Series B in December of 2024. We announced it in May of 2025. And then we just raised the $100 million Series C beginning of this year.
Wow, amazing. Yeah. What was the hardest round to raise?
The Series B, actually. The Series B was the hardest round. Honestly, so it was relatively the hardest one to raise. I thankfully have never had a difficult, quote unquote, time capitalizing the business, in that I only have gone out to raise money when I don't need to raise money. And many founders make the mistake of raising money, waiting to raise money until they actually need money. And so I've always found that, look, the way early stage, the way private companies get prices on it's just due to competitive dynamics. It's just like, how much is an investor willing to pay to win the deal, given that there's other investors willing to pay to win the deal? But it's always helpful when you have competitive dynamics, starting with one player, which is yourself, not raising money, right? Like I always go into these fundraisers knowing, hey, if we don't raise this round, I literally don't care. I can go back and keep operating my business because we're very capital efficient. We have lots of runway, or very recently, like we're profitable. So yeah, that's kind of been my approach.
Yeah, well, hey, that's a great approach if you can do it right. That's a awesome luxury to have. But yeah,
it's actually very possible. Like founders just do not very disciplined. Like it just does not take that much money to build great software. It does not take that many people. You just need to have a lot of discernment. You need to be willing to work very hard yourself, and drive every outcome with extreme urgency. And I think it can be very capital efficient that way. And yes, it's there's certain industries that are more capital intensive, but I really recommend, because there's all these people come to me when they ask for fundraising advice, and they ask for like the strategy of it, right? Like who should I talk to first, and like how should I, how long should I wait to respond to this email? And I'm like, dude, like those things are going to help marginally. What's going to materially actually help your ability to close this round is if you have a freaking awesome business.
Yeah.
So I think that's what I always recommend founders.
So if you didn't, all those different rounds, if you didn't absolutely need to go out at those points in time and raise, what made you decide to go out and raise at?
Yeah, there's a few different reasons. So one is just, it's important for fintech companies to be well capitalized, and it just from like an actual go to market and acquiring customers perspective, it's much easier for us to acquire customers if we are a very well capitalized entity. People want to bank and spend with a company that they know is not going to go under, and that they know not even it's not going to go under, but like it's very, very legitimate, very, very well funded. So there's that. So it helps with customer legitimacy. It helps with talent legitimacy as well. There's one thing, which is how fast is your business growing, but then there's another thing, which is employees in Silicon Valley have a lot of optionality, and they want to work at the fastest growing businesses from like a valuation perspective. And so constantly making sure that we have momentum and communicating to prospective employees that the business is growing is important. And then another one is just like, yeah, there are certain like, it's easier to make larger bets when you know that you're very well capitalized. So one thing we did, actually, this was probably one of the riskiest things we did, is there was a point in time where our business had like $12 million. And then we wanted to get as close to the metal as possible. We wanted to build our own issuer processor and integrate directly with a bank. And we basically had to commit $6 million over the course of a few years to do that. And so we're committing half the money that we had on our balance sheets to optimize our banking backend infrastructure. And that was a tough decision. Like it was 100% the right decision to make, but it was very tough for me to make it, because I knew that it was a substantial part of our money that we were committing towards this one initiative. And so if it didn't work out, the entire business was at risk of not working out. So if you're well capitalized, you can make a lot more of these important, bigger bets for your business.
And I don't know your industry that well, but is what you just said, does that mean you are becoming an actual bank, whereas some of your competitors, I believe, are kind of using a legacy bank as the back end, and they're more of a marketing online front end? Is that accurate at all?
No. We're not becoming an actual bank yet. I think at some point in the history of Slash, we will definitely have a bank charter. Right now, we like this model of a good parallel is NVIDIA TSMC, where it's just NVIDIA is the chip designer, and then TSMC actually owns the fabs and they produce the chips. Same thing with us. It's like we just build a phenomenal product and we send it to our customers, and then we have partners that provide the regulatory infrastructure to allow us to do that. So it's more that we are just directly integrated with one of these banks instead of being integrated with one of these banks through an intermediary platform.
Mm-hmm.
And also that we directly process our card transactions with a card network instead of us using some third party to allow us to do that. So that allows us actually to keep the lion's share of the card economics and allow us to be the most call it rewards aggressive with our end customers.
Random question: when you went into college at Stanford, did you want to go into banking? Like, was this sort of part of the plan, or you just sort of got into?
Honestly, I knew that I wanted to start a business one day. One of the cool things being from Latin America is that you very much are pushed towards entrepreneurship. The crazy stat is in Venezuela, I think there's 7 million entrepreneurs in a country of 30 million people. Everyone makes money by just like selling some sort of a product. It's like Latin America is a very entrepreneurial continent. Even at the highest levels. In the US, you can actually get very rich by being a banker or being a very successful executive at somebody else's company, or being a consultant or having this like great corporate career, that doesn't really exist in Venezuela specifically, or Latin America, or most likely broadly in Latin America. So if you want to get rich, or you want to be like all these successful people that you see around you, you have to start a business. And so I knew I wanted to start a business. I didn't know it was going to be a fintech business, but I definitely went to Stanford knowing that I wanted to start something in Silicon Valley, because I know that that's where the world's biggest businesses get started.
Yeah, interesting. Are you from Venezuela? Is that where you came from?
I am, and I grew up there first 18 years of my life.
Awesome. And all right, I'm going all over the place, but how'd you get into Stanford from Venezuela? Any like secret stories there, or secret sauce?
Um, Honestly, I was very privileged to go to an American international school, so it was quite common for people to apply to U.S. colleges from my school, and so the all the things that you needed to do to get into a U.S. school were very as visible to me as they were to somebody that went to school in the U.S. You need to get a good SAT score. You need to do all these extracurriculars. You need to do all these other things. And so I guess I just did all the things. I mean, I think the number one thing when you're getting into college is you want to package yourself in a particular way. You want to make it easy for the admissions officers to refer to you in like a couple words, like, oh, this is the Venezuelan student that's obsessed with creating opportunity for others. And so, like, I don't know. I guess like I kind of understood how to play the game very early on.
Was that your packaging? Was that sort of your
Yeah, that was it. That was it.
yeah.
It's like a lot of what I did was about like creating opportunity for others. And every kind of like extracurricular activity I did, like it was all kind of in service of this narrative that I was crafting for when I was applying to college. So I guess it's just a matter of, was lucky to have gone to an American school where you kind of know what you have to do to get into one of these schools. It wasn't like I completely first principles that and I had to like figure it out from scratch.
That's interesting. Did you finish Stanford, or did you drop out?
Dropped out to work on this business full
Classic
time.
story of American entrepreneurship. I love it. And
Oh
you have
man,
an
it was
interesting. Yeah, go ahead.
yeah.
Oh well, so I've actually had full disclosure. I had, and it was a couple years ago actually, but Brex founder and Mercury founder, and both those, I wasn't um, Brex founders are from Brazil, I think.
Brazil.
Yeah,
Yeah.
right. And then Mercury, I'm not sure where he's from, but right, it's kind of the similar stories. It's kind of amazing. These.
Yeah, I think he's in it. Mercury Founders is from the UK, or he's like a Indian British guy.
Yeah, that's right.
But it's
Imad.
pretty crazy because the Brex one is very similar. Like in a way, like my story is very reminiscent of theirs, which is they're just Brazilian guys came to Stanford, dropped out to start a corporate credit card company, and I was just like a little fit from the north. And then I did the same thing like a few years afterwards. So yeah, I guess steal like an artist, or I don't know, to follow the proven path.
Oh, I love it though. Um, Very cool. I won't keep you. You've got a pretty interesting business to run, but any other tips, like you said, when folks come to you, maybe other new members to YC asking for fundraising advice, what else do you give them? Or what would you give your younger self if you were doing this all over again?
Look, the one thing I would tell my younger self is just like be patient. You only have one company, which means there's only 100 points on the cap table, and once you dilute yourself, that part of your business is gone. Once you sell part of your business to an investor, you're not getting that back. And so just be very cognizant about taking bad deals when you're first getting started.
Mm,
And just be patient. Wait until you have more leverage so that you can raise a round that's less dilutive, because the thing that you own is your company. Like whenever you are raising money, you're basically making the following transaction. You are trading off a percentage of all the productivity that you as an entrepreneur will have in perpetuity if you think in earnest that you're going to be working on this business for a long time, for a given amount of cash. That's the trade-off you're making. I'm willing to give you 10% of my productivity for the next 20 years of my life for $2.5 million today. That's if you raise a $2.5 million on 25 million seed. And so just like make sure you're actually willing to make that trade-off. And this investors have all, the thing is, investors are in a fundraising environment all day, every day. So they know all the tricks, they know all the right things to say to make it easy for you to rationalize you making a particular decision. So it'll be like, oh, it's not that much dilution. It's only like 3-4%. But like, dude, like that's 3-4% of your entire productivity over the course of the next couple of decades of your life. Like take it seriously. And so that's something I would tell my earlier self. Like I wish I wouldn't have raised all that money before like the official seed round. All the rounds after that, I was like extremely dilution conscious, and we basically sold none of the business. So now I actually think I own a lot more of my company than a lot of founders in like my stage do. But it was something I definitely had to course correct afterwards, and I wouldn't have been able to if I didn't have the business that I had. So that's one piece of advice that's not tactical. It's more just like foundational, like just like very principled.
Are you can skip this question. Are you willing to share like what percent you own after 160 million in Series C? Like that's, a
I
lot of
own
money.
I own almost a quarter of the business.
Okay. Yeah.
So yeah, so my co-founder and I own almost 50% of the company, just under that.
Amazing. That actually is quite impressive. I talk to founders all the time and I tell them stories of founders I know who, raised a lot of money, ended up with
It's
single
just really
digit.
important because then you demotivate yourself, right? Like your opportunity cost is an opportunity cost to everything you do. Like I could start a brand new company. I would not. I'm going to be working on this business for the next 20 years of my life. But if I own maybe only like 13% of this company, I would be like fuck it. Like I'm just going to like start like something new. So it's very important that you don't dilute yourself because it like actually maximizes your odds that you're very successful.
Yeah, that's amazing. All right, my friend, this is all really interesting. Any other words of advice you want to share with founders, entrepreneurs, fintech startups, anything at
Um,
all?
Fundraising is cool and flashy, but owning a bigger chunk of your business is much cooler and much flashier and less flashier, but much cooler. Um, Time bucks are raised. Don't talk to investors if you're not raising money.
Not at all. What if they reach out to you? Do you talk to them, or you say, "Hey, I'll come back when we raise the
Really
next
not
one"?
like right now. It's a little different because like the next time I raise money, it's gonna be like a large 9-figure round. And so like you kind of want like it's much harder to shotgun that large of a relationship. But if you're earlier stage, like yeah, you really should just be focused on like writing code and talking to your customers, and that's it.
Yep. No, I think that's good advice. Build and sell, and to build, talk to your customers
Exactly,
nonstop. I
and
love
only
it.
raise when you only raise when you need it, and raise ideally, or only raise if you have a good reason to raise, but try to raise at a period of time where you don't actually need the money to generate as much leverage for you. There's Emil Michael, he was chief business officer at Uber for a long time, like master negotiator, and he basically has gone on some podcast saying that like the only thing that matters when you're negotiating is leverage, and everything else is just hopes and dreams. So you can do all these like tactical things and like sound very snarky and cool, but like if you don't have leverage, you're screwed.
I love it. I love it. That might be the clip of the day right there. That's good. Um, very, very cool. If people want to learn more or sign up, where should they find you? Where should they find the business? Any call to action? Anything you want to plug or promote?
For sure. Just go to slash.com. You can self-serve sign up, submit an application. It'll probably get approved same day or within one business day. And we'd love to work with you. We offer the most rewarding banking platform in the market. If you use our treasury account, it's yielding 3.79% if you keep over 500K in it right now. We have a 2% cashback card, and you won't be disappointed with how granular the spend control that we give you is. So yeah, you should totally consider signing up for Slash.
That's very interesting. I like it. All right. Thank you very much. Good luck. We'll catch you after your next, what would you say, 9-figure raise or whatever it was?
Hey, we'll see, man. It's a long journey, but it'll probably give you a while from now. We have enough money to execute for now.
We'll catch you after that one. See if you're in a pinstripe suit and top hat at that point.
Oh, man.
Banker monocle.
Let's go. All right, Nathan, thank you
All
so
right.
much.
Thank you. Bye.